Hey, this is 𝗥𝗙𝗚𝗪𝗧𝗍. If you're looking for discounted stocks to invest in, a popular way to do so is by screening for stocks at 52-week lows. This is something legendary super investor Michael Burry does, the guy who correctly predicted the 2008 mortgage crisis, played by Christian Bale in 2008 The Big Short.
Here's Margot Robbie in a bubble bath to explain.
Basically,
It's also something that Jason Wigg recommends. Jason Wigg is the guy that updated Benjamin Graham's The Intelligent Investor on behalf of Warren Buffett. Benjamin Graham was the teacher of Warren Buffett, and Warren Buffett is the best investor of the last 100 years. And basically everything that he learned that set him on his journey was in Benjamin Graham's original book, which Jason Wigg has just updated for modern times. One of the things that he recommends in this book, and he even tells you how to do it, is to screen for stocks at 52-week lows. Now, while filtering for stocks at 52-week lows will naturally find you discounted stocks, the real question is the newly discounted price a fair one? Perhaps the company is actually heading towards bankruptcy or some other threat has emerged. In my opinion, one of the good ways to separate some of the wheat from the chaff is by filtering for stocks at 52-week lows that are also owned by some of the world's greatest investors. And thanks to a site called 𝗙𝗙𝗪𝗪, we can do that easily. Please join me as I go over more than 30 hours of research into 5 stocks in hopefully under 10 minutes. The stocks I chose to research for this video were Coca-Cola, Pepsi, General Motors, Wendy's, and PayPal. And so in no particular order, here we go. Teddy just had a bark at the postman, so now he's moved down to here. Anyway. So the first stocks that I'm going to be going through are Coca-Cola and Pepsi, and because they're both so similar, I'm going to do them at the same time. Funnily enough, or not surprising at all, both these stocks are simultaneously at 52-week lows. So whatever is affecting these stocks, it's affecting both of them. One fear that I heard was that something to do with the new anti-fat drug is going to affect sales of Coca-Cola and Pepsi. That might be true in the short term, but I really don't think this new drug is going to affect sales in Coca-Cola long. I think the more likely answer for what is affecting these two stocks is the rise in government bond yields. Long story short, I really don't want to be getting into COVID, inflation, interest rates, and Fed rates and all of that, but basically government bond yields have been going up and are likely to continue to doing so. And so when government bond yields come up, the safest possible investment you could make are going up to like 4%, 5%, 6%. That really makes the 3% dividend in Coca-Cola and Pepsi become much less appealing. I did some calculations on the dividend earnings at this price, and basically if you invest £1,000 today or $1,000, you'll get around $344 in 10 years time. Now of course we can anticipate that that dividend income will go up over those 10 years. Assuming a compound annual growth rate of 5%, that goes up to around £468 or dollars. Obviously it could be anything outside of that, but in my mind the most likely thing is somewhere in between those two. And also, by the way, that's by reinvesting the dividends every year. Coca-Cola and Pepsi have not seen significant growth for decades, and even though they have beat the S&P 500 in their lifetime, that was really in the early days of their growth when they were covering the entire world. Now the only way Coca-Cola and Pepsi grow is through acquiring new companies, which eats up loads of cash. It's a great way for them to grow because they can incorporate those new companies into their marketing structure and stuff like that and make them run more efficiently, but it just doesn't mean big growth. Okay, moving swiftly on, let's talk about PayPal. Since 2018, PayPal's revenues have doubled, and yet its share price has been tumbling. It's down 27% since 2018, and it's more than half its price. Half? It's from 300 to 50 since 2021. That's an 80% decline. It used to be if you wanted to buy things online, you wanted a bit of protection on your payment and you didn't want to type in your 16-digit code every single time. PayPal was pretty much the only reasonable solution. Now there's Apple Pay and Google Pay. The fact that there is competition will affect PayPal on 3 fronts. It will hurt them from gaining market share globally. It will hurt their margins per transaction, and it will mean fewer transactions per viewer. Their competition can also use other revenue streams in order to price cut PayPal. PayPal get all of its revenue from transactions, whereas Apple can offset its iPhone revenues in order to undercut Google and PayPal, and Google can do the same. However, this negative sentiment certainly does seem to have overshot. For now, they're still making incredible margins, which they can use to pay off their tiny amount of debt. They actually have the same amount of long-term debt as cash, so they could pay that off today if they really wanted to. They're also using this cash to buy back equity in the business. This will be great for the earnings per share long term. Ultimately, this is the challenge for working out whether you want to purchase PayPal stock. I definitely see it as the cheapest transaction company around today, but I also see it as kind of the worst. Next up, Wendy's. They have a relatively low PE to their growth, and if you didn't know, they're a burger restaurant. We recently got our first in Brighton. However, doing research for this video, I watched a comparison between UK Wendy's and American Wendy's, and they seem like very different apples and oranges. God, I'm so bad at analogies sometimes.
And here is everything you get at US Wendy's you can't get in the UK. This is ridiculous.
Anyway, they're very different companies. When Wendy's first moved to Brighton, I went there to get a burger just to try it out, and honestly, I was just not impressed and decided that I'll probably never go back there again. I do see people in Wendy's, but just nowhere near as many people as I see in McDonald's. So even if McDonald's is more expensive, that's the business that I prefer to be holding. They make nice fat margins and they have been buying back shares, although 7% in 5 years isn't really something to write home about. However, for me, the real issue for this stock is the debt. They have a debt to equity ratio of 8. 4 billion in debt, 300 million in operating cash flow. In a rising interest rate environment, that to me is a big red flag. Perhaps I'm valuing these companies wrong, but to me it seems that the debt is going to eat out any value, eat out any value for shareholders over the coming decade. So let's move swiftly on General Motors. Over the last year, GM's price has fallen 30%. Over the last 3 years, the price has fallen 50%. The big concern here is that they have cancelled their generous dividend and there's no clear indicator as to when that dividend will come back. Typically, it's exciting when dividend yielding stocks go down because that means that the yield of the dividend is going to go up. It's also concerning to me that Buffett, the Oracle of Omaha, has exited 45% of his position. The reason GM had to stop its dividend was back in 2021, if you can remember, there were enormous supply chain issues affecting all car companies. So to be fair, this isn't something unique to General Motors stock. And interestingly, GM has managed to maintain the same market share during this period. They still sell 16% of the cars in the US. Hopefully GM can pull its dividend back to 36 cents with its introduction of higher margin electric cars. However, again, there are companies like Tesla and Rivian that are going to make it very hard for General Motors to get the margin they want from their new electric vehicles. Tesla's innovative factory design make them uniquely good at manufacturing incredible cars at an incredibly low cost. You also get the benefit in a Tesla car that you'll potentially have a driverless vehicle whenever Tesla decide to do their software update. While Rivian can use Amazon and Amazon Web Services to offset the cost of setting up, manufacture, and infrastructure, giving them a short-term competitive advantage and pricing power. You might think that General Motors' debt is a big concern, however, a lot of this debt is owed to GM Financial. This is something I learnt about when I was purchasing Volkswagen shares. Basically, a lot of people buy cars on finance direct from General Motors, and when they do that, General Motors give them the car and it goes on the balance sheet as debt, even though that's technically money that will be paid to General Motors in perpetuity. Perpetuity? Not sure if that's the right word. Anyway, you get what I mean. When looking at the balance sheet, you can see how much General Motors is owed, and typically you want this number to be going up. The number that you do not want to be going up is the amount of receivables late by more than 30 days. That's basically the amount of people that are defaulting on their car payments. Basically, with these numbers continuing to hold under 3% of the business, 3% of the financing, that really doesn't seem to be a concern right now. But if interest rates continue to shoot up, we could potentially see that number rising very quickly. It would certainly be devastating for the share price if, once again, we saw the CEOs of all the major car companies flying in private jets to Washington in order to ask for more money again. It is, of course, incredible to see General Motors at a price to earnings of 4. However, I do not trust that its debt is actually all it seems, and I am concerned about its dividend and the fact that Warren Buffett has exited his position. Again, this just doesn't feel like a home run for me. In conclusion, while all of these stocks do appear to be at very good discounts from a year ago, Coca-Cola and Pepsi, their discount is not enough to match premium bonds in my opinion, and I think the S&P 500 will continue to outperform them in terms of earnings and income growth. For Wendy's, PayPal and General Motors, I don't think I understand the moats well enough for me to feel comfortable investing in them. Of the three, I think PayPal is the most interesting, but I think I'd still prefer to pay extra for companies that have better looking horizons. Of the three companies, I think PayPal to me is perhaps the most interesting, but I think at this point I'd still prefer to pay extra for companies like Google and Apple that have much better horizons and also a broader amount of revenue streams. Revenue streams are products that I use on a daily basis. So while it feels a bit exhausting to have done 30 hours of research and come to the conclusion that I don't want any of the stocks, remember guys that just because you've investigated something a ton doesn't mean you have to buy it. I don't understand baseball, so I'm going to butcher Warren Buffett's quote a little bit, but you don't want to be batting every single ball. Basically, you just want to be batting the home runs. God, please just research that quote yourself. But yeah, don't try and swing for everything. Look for the home runs. I'm not going to explain it again. I think you get the picture. If you enjoyed this video, please remember to like and subscribe. And yeah, say hi to Teddy in the comments section and I will pass your message on. And yeah, that's all from me. Thank you very much. Goodbye.